This episode covers risk appetite and risk management framework. The following is an audio summary of that podcast episode. This podcast is educational and is not legal advice. We are sponsored by Credit Union Exam Solutions Incorporated, whose team has over 240 years of National Credit Union Administration experience. We assist our clients with NCUA so they save time and money. If you are worried about a recent, upcoming, or in-process NCUA examination, reach out to learn how they can assist at marktrichel.com. Also, check out our other podcast called With Flying Colors, where we provide tips on how to achieve success with NCUA. Executive summary. In this episode, Mark Trichel, Steve Farrar, and Todd Miller discuss the essential components of risk management frameworks for credit unions. The conversation covers three main areas. First, the importance of risk culture as the foundation of any effective risk management program. Second, the development and implementation of risk appetite statements that scale with institution size and complexity. And third, the three lines of defense model that provides oversight and control. The experts emphasize that while these frameworks become more sophisticated as credit unions grow, the core principles apply to institutions of all sizes and directly impact NCUA examination outcomes. Main Topic 1. Risk culture. The foundation risk culture sits at the top of the risk management pyramid and represents the most critical element of any framework. As Todd Miller explains, you can have the best policies and organizational charts in the world, but without proper risk culture established by the board and management, everything underneath will be ineffective. This tone from the top must permeate throughout the organization, creating an environment where staff consciously consider risk-reward decisions rather than operating unconsciously. Think of it like crossing the street. We all practice risk management when we look both ways, but in financial institutions, this needs to be conscious rather than unconscious behavior. Steve Farrar notes that when examining troubled credit unions, problems can almost always be traced back to a breakdown in risk culture. The culture must encourage staff to speak up when risks are getting out of hand, creating that essential foundation for everything else to work properly. Moving to our second key area, Main Topic 2. Risk appetite. Defining your boundaries. Risk appetite statements vary significantly based on institution size and complexity. For smaller credit unions, risk appetite can be expressed informally through business plans and policy limits such as loan policy limits, liquidity policy constraints, and asset liability management boundaries. As institutions grow larger and more complex, NCUA expects formal risk appetite statements that address all 7 NCUA risk categories, with some regulators adding concentration and model risk. The key components include both qualitative statements about the institution's risk philosophy and quantitative metrics for measuring and monitoring risk. Steve Farrar emphasizes that risk appetite should start with capital levels, as institutions operating near PCA triggers need conservative appetites, while well-capitalized institutions can accept more risk. However, as demonstrated by the taxi medallion credit union failures, even institutions with capital ratios exceeding 15% couldn't survive when medallion values dropped from $1 million to $100,000 in New York City. This shows that extreme concentration risks can overwhelm even strong capital positions when fundamental business models change. Now let's examine our third critical component. Main Topic 3. 3 lines of defense. Your control structure. The 3 lines of defense model provides the operational framework for risk management. The first line consists of frontline business units, including loan officers, tellers, and member-facing staff who interact directly with members and conduct transactions. These employees must understand their role in risk management and carry out operations consistent with board policies. The second line of defense, typically seen in larger institutions, involves a separate risk management department under a chief risk officer who aggregates risks across the organization and provides independent oversight. The third line is the internal audit function, which tests internal controls and verifies that systems work as intended. Todd Miller notes that smaller credit unions often operate effectively with just two lines of defense, combining the first line with internal audit oversight, while institutions crossing $1 to $3 billion typically add the second line risk management function. It's important to note that NCUA sometimes overreaches by trying to dictate whether chief risk officers should have voting rights on committees or veto authority over decisions. These are management decisions that should align with your institution's size and complexity. Key questions for your board. Before we discuss exam impacts, consider these essential questions for your next board meeting. First, can you clearly articulate your institution's risk appetite in both words and numbers? Second, do you have appropriate limits in place and consequences when those limits are breached? Third, does your staff feel comfortable raising concerns about increasing risk levels? Fourth, are you managing risks in silos, or do you have a way to see the big picture across your entire institution? And finally, does your risk management sophistication truly match your credit union's size and complexity, or are you either over-engineering or under-preparing? These questions can help guide meaningful board discussions about your risk framework. NCUA exam impact and takeaways. These risk management framework concepts directly affect your NCUA examination in several ways. First, examiners consistently look for concentration risk limits supported by capital analysis, particularly in larger organizations where stress testing may be required to justify limits. Second, NCUA expects action plans when institutions approach or exceed established limits, and failure to address limit breaches can result in examination criticism. Third, the sophistication of your risk management program should match your institution's size and complexity, but examiners sometimes inappropriately apply large institution standards to smaller credit unions. Fourth, proper documentation of risk appetite, whether formal or embedded in existing policies, demonstrates to examiners that management consciously considers risk decisions. Finally, having effective lines of defense with proper independence and adequate resources shows examiners that your institution has appropriate oversight and control mechanisms in place. If your credit union could use assistance with your exam, reach out to Mark Treichel on LinkedIn or at marktrichel.com.